We have a market making another huge upswing today, and we're going to take you through our favorite stocks, like we said yesterday, for the rest of the year, give you all the numbers, the research on them. But first off, right now, we're using our very new site, fortgamma.com. It's free to use for everyone right now. Basically, in the very first version of it, we're going to be rolling out so many more versions, and this is going to be to help you guys for investor tests. But like we said, right now, free, no trial period, no nothing. Right now, you guys go on here, can make all your projections, save all this stuff on the site, completely free. All you got to do is enter in your email and verify your account, and then you go on here, and it's completely free to use. So right here, let's just take a look, or watch us with our stocks that we really like. Look at these all today. Look at all that green right there. Look at what's going on with the basic materials. All these sectors completely up, and the best sectors to see that are down are the consumer defensive and the energy, showing that. What does that mean? That means all this growth is coming back into the economy. So you have your tech up, your consumer discretionary, your financial services up big. We're going to get to that reason today. And then you have your bonds over here still pretty elevated because of the possible inflation and what happened today with. But the PPI did come in at 4.0% instead of 4.6%. So that's pretty good that it beat less on those estimates. So that's great for the market. And you got up here, you got your Mag 7 really running through, pretty much hot on the day except for Apple. Because as we know, Apple was the one that was kind of staying up for the very long time. The one that was outperforming because they weren't doing a crazy amount of CapEx. So that's what you got going on today. Earlier today, we actually had some earnings come in, right? So we had JP Morgan, we had today with the financial sector. That's why you see that sector up so much today. JP Morgan came in, beat on revenue, huge beat on EPS. And then you also had Wells Fargo Company, and they missed a little bit on revenue, but on the bottom line, they got much more profitable. And then earlier this week, yesterday, we had Goldman Sachs coming and beat at 1.4%. EPS smacked that 6.6%, contributing to this good economy. And then another even more important that really got the market going this week was whenever Delta came in and reported, right? What does Delta do, right? They're a company, planes, travel, expenses, right? So if they're saying, hey, the travelers out here still spending a lot of money with us, even with all this inflation and everything, you're pretty much assuming the economy is going to be good. Because say you're going to go and you're going to travel somewhere, right? What's going to happen is you're going to end up paying money to go there. You're going to bring money into the area, and people traveling, going on vacation, looks like, hey, they're making enough money. They still want to keep spending. So that's a sign of a resilient consumer. What we're going to do today is we're going to show you around the site a little bit, go through our projections, go what to see. Right here, we got a nice research tab over here. So basically, we have our company selected as AMD, and you kind of see their income statement, their margins for however many of the past years. You can go in here, see their whole balance sheet, all these big ratios, everything here. Their statement of cash flows for your DCF calculations, everything you want to do on the site, all the research, even more and more coming on top of this. This is just great to see, hey, is this company improving year over year? Are they getting worse before I want to invest in them? And right here we see, look at all this improvement, cost to revenue, all these changes. And later on, we're going to be doing some grading and everything like we do in all these videos and the really deep dives of these companies coming in. We're going to re-upload them because we rebranded and everything. So let's get right into the projections right here with AMD. We're going to go through a little bit. This is what we have for cases, but let's just lead. Why in the world is AMD stock up so much, right? Basically, look at AMD has been flying all the way down here because their server CPU, they're able to increase more and more prices because the demand for them is there. So what in the world does that do if AMD can increase CPU prices for your computers, your laptops, right? But let me just get first. CPUs, right? What are you watching this on, your laptop or anything? A CPU chip is in here making sure this runs. So whenever they can go and make their prices higher, what does that do? You're making it for the same price, but you're charging more. Your margins are going to go up. And then the GPU, we know. A lot of people using? They're using Claude, Chat, Gemini. What do these all use? They use all those GPU chips that AMD, the NVIDIAs make to go and power and do all that intelligence. So the more and more you guys use them, the more and more people use Chat, Claude, AI, all of these, the more chips that need to be ordered and the more better chips that came out. AMD even recently had come out, their chips are actually super, super close to NVIDIA's B200 in their AI intelligence, showing that they're making up that gap, the performance gap. And since NVIDIA charges crazy high, like let's just go here. Let's just use our site right here, right? Let's go here and let's switch over to NVIDIA, right? Let's go see. I have it in here already in case. Look at these margins they're getting. Look at these margins. 71% margin right here, right? Look at these crazy margins here. because they already reported their 2026 year. Look at what in the world that these companies are going in with their margins right now. 74%, 62%. Like, what? Net income, bottom line, 55%. Look what AMD's only running on their margins right now, right? They're only running 6%, 12%. So they have so much room to grow these margins and get up to even get close and eat into AMD's pricing power that they have. So let's go ahead and look at we're going to take you through a DCF of them and what we have for our basically price to sales. So you can see, you go your market cap, your share price up here, right? So for our base case, what we expect to happen is Lisa Su said revenue growth is going to be about a 35% CAGR all the way to 2030, maybe even past then, right? So revenue growing at 35%, 35, 35, 35. You can just go put it in right here, 35, and save up here. You usually can just hit a save to go off. Net income growth, 127%. Here, right this year, you're going to have a big, because the way that the site, when we do it on here, is because it's reported in GAAP. A lot of these companies, right, these tech companies are reported in non-GAAP because they have a lot of stock-based compensation. But because they report it differently, the way you pull data, it always has to be changed, whatever like that. So that's why they're going up by this so much. We have their 10% dilution here because we know they have those deals with Meta, and we know that they have a deal with OpenAI. So if those go through and they hit that share price for the company, then they're going to have to go and dilute, which is okay because you want Meta, you want OpenAI to have a vested interest in keeping and buying these chips from AMD to make them, because they're actually invested in the company. So while everyone's out here like, oh my God, my company's getting diluted, we're so screwed, that's terrible. You have to look at it from another play. $1 billion and going to be a trillion market cap company has a vested interest in 10% of your company. What does that mean? They're going to keep buying from you, especially as your chips get better, giving you more deals, more recurring revenue. That's going to make that share price skyrocket to what we think it can get to, right? So we have a 45 net income growth. And with this, basically the forward PEG ratio, right? I don't know if you guys know exactly what that is. We have a calculator using exactly that here. But for right now, we're not going to go and use that one for this company because we like projecting it this way. Some companies you want to use that. Some companies you want to use price to sale, like ones that we have a different company named OSCR, which we're going to show you that function sometime later. Basically, we're going to go into 60 to 70p ratio is pretty fair. That puts them at about a high forward PEG of 1, and this is 1.55 because what is forward PEG, right? Forward PEG takes your price of the share today, so we use the average midpoint of the share, divided by the next year's PS, right? And then you divide that, that gets you your forward P. That forward P, divide that by the EPS growth rate for the next year. That gets you your forward PEG. So a lot of times whenever you're looking at companies, some sectors in that trade differently. But to be fair, like a 1 forward PEG is fairly valued, under a 1 is undervalued, and sometimes over a 1, depending on the company, the sector is going to be overvalued. So that's what we go here. And with this total, we have a grand total of a share price mid of $1,084 and a CAGR of 45% over the next 4 years. The market only grows at about 10%, so you're going to be outperforming the market by 4 times in this stock with our base case, which is super attainable considering that Lisa Su's a sandbagger, and we're basing these numbers off of her sandbag numbers, pretty much exactly what she does. So let's take you to their bull case of what in the world happens if, hey, you see right here, 35, right here, 40%. They go and they put in their revenue growth, right? Revenue growth gets up to this. Net income growth, right? If they're growing higher revenue, maybe getting better margins, more deals, then next thing you know, hey, net income growth is going to grow higher. Right here, we get them at about a 20 EPS by 2029 for non-GAAP, which is great. A higher P of 70 to 80 for a company growing 40, 50, 70, 80 is very calm, very fair. It could even be higher because you see, again, that forward PEG is only 1. And that gets you at a midpoint share price of $1,463, a 55.62% CAGR. And from right here, that's a 6x and a huge company. Now, we always want to go and take a look at our base case. So we got them at 20% revenue growth base. And we have their net income honestly growing at 24, 23, 22. But for this company, right, if this industry is $1 trillion industry, which is projected to be by 2029, they would have to have only a 7% market share to put this. Right now, we think that even just with a 11% market share, they get you their base case. Right now, they're trading, so they're going to keep growing in everything in the space. And even with that, you're still losing about 8% a year, so that's not a good investment because you always want to take a look at all the possibilities. We have a DCF for them. So basically, we have the DCF in here as 35% revenue growth, like this is our base case, And we have our free cash flow margin growth at 5%. Terminal value growth rate at 3%, reasonable in that high industry that's going to have demand in the futures. Regression years 15, FCFF 30%, revenue growth 5%, tax rate 13% is what they're being taxed at. 5.5 market risk premium, beta, it loads it in for the site. So with all of these numbers being pretty conservative, right? You're getting a intrinsic share price of $434, almost a double up from this share price. If we were talking to you a week ago, whenever we had these numbers were running, you would have had a double from there. But just think about this. Think about the rest of the market. This maybe is going to grow like 80% this year. The market will go at 10% this year. So just think of that. That's pretty crazy. So we can go here, save, and then let's say we want to go make a new one. AMD Bull, right? Let's just do this DCF, right? Let's just run quick numbers. Okay, so say they grow actually at the top line, they grow at 40% revenue growth, like we think, right? Beta 1.963. Market risk premium states at 5.5. Risk-free rate's 4.3. That's your 10-year. A lot of people use. Tax rate's 13%. Terminal growth is 3.33%. And regression years, say they actually grow for 17 years, and their terminal value FCF margin goes up to 33, and their, say, revenue growth stays at that, right? And then say they grow FCFF margin at 6%, 6%, 6%. This is how easy it is to go and put and use our site to put in all of these discounts. So if you're getting a company, so let's say they're growing at 16 years they take, right? All you have to do is easy save right here. Just putting it in this, you're getting them at a 3x is really their intrinsic value if they actually can manage to grow at these numbers, these margin growths. So this is just the utmost possibility potential they have to this company. And whenever this hype cycle is going with the GPUs and them, watch out. This is a train coming down the track. Our next stock we want to share with you today is SOFI. So basically, why they're up 5%, right? We were talking about all the earnings for banks coming good. Whenever the industry is doing good, you think, hey, SOFI's also going to have good earnings because people are going to go put money in these companies. If you don't know about SOFI, they're basically a company which you can do your loads on, you can do crypto, you can have a bank account, credit card, all of this in one place instead of having to have like a Charles Schwab bank account, an Amex credit card, student loans with some other bank. Basically, they do it all in one, and they give you a 4% API. And the big thing about SOFI is, say this generation comes into SOFI, right? Whenever they keep putting money in, people are going to make more and more in their life. So then basically, they're going to end up making a crazy amount of money, and they're going to keep putting money in, and SOFI is going to grow. On top of that, they sandbag almost every quarter with their CEO. They're basically projecting that they are going to have, we're going actually pretty low with their EPS this quarter. I think, sorry, this should be easy. So EPS, they're projecting about, and we'd like to go and say, hey, like they're going to beat this many quarters. So we're going to go and say, hey, they're going to come in here and do this amount of EPS. Let me see. I think they're, what even their bull case? I think this bull case here, like look how easy it is to change the stuff on here, right? Say you make a mistake or something. Bang, easy change right there. I think they're projecting about a 0.62 EPS. Let me look it up. SOFI 2026 guidance. Right, let's see what their EPS is. Let's see what Anthony No has in them. And like, so EPS, yep, so 0.60, right? And we said they sandbag, so they basically missed by about 0.02 each quarter. So this is just us saying, hey, 70%, only up to 0.64, so they barely even beat this next year. They only have a little beat, and we've seen these companies coming and beating by 10% is what the average bank or someone's doing right now, right? So a 10% beat from that is about our top case right here. But you can, whenever you're going bull, right, you want to say, hey, like this company's going to go crazy outperforming in the future, right? So if they put up a 0.72 EPS, this base case here, 0.64, that's fine. You could probably put up to 72 actually, 0.65. So that's them beating by only 5% this year, like they guide. And our bear case is them falling off. Let's just go look at our base case numbers. So we're running about 42%, saying they're going to beat by a little bit, like that 5% each and every year after this, what their numbers are. Because they said a 40% income growth CAGR till 29. And the way Anthony Noda guides, he goes and he comes in and he guides for the lowest possible. So with this 50-60 P ratio, that only gives them a 4 PEG of 0.96. And the way we value them more as a tech company. Because what banking company, what Goldman Sachs, what JP Morgan is growing at 42% year over year? That's a tech company. That's growing faster. That's almost growing like our AMD company. So why in the world are they valued at like a 10 to 20 P like a bank whenever they're growing at this high? So the market's obviously going to fix that multiple. And that's why while it's really cheap right now, you can get it for huge gains in the future. So let's come here. Let me go and organize. So let's say they come in here. They put this. You're getting almost a 60% CAGR in a mid price. They're going to be about $100 stock by 2026, and you're getting them for about 17, 16, depending on whatever you buy and do the projections. That's where you're getting this company at. Your bull case, if they go above and beyond, get more members, and just keep beating almost like they have been at this point, and just beat a little bit more than what they really have been doing, you're going to get them running. These pay ratios are low. Also, they could be some of these companies trade at higher. If they're really growing at these levels, you're getting to 144 share price in 2029, which is going to go and be a 75% CAGR every year. So you want something close to your 10x, so you're getting it. Now, what are the problem with banks, right? Credit crises can happen. They can go down bankrupt. That's why they're always dangerous. And we see if they would get something happen like this, they would go down to $5. So banks are usually a high risk, high reward type of company, depending on if they're early. But like something like Goldman Sachs, JP Morgan, they're always at risk in credit, but they're pretty made in the future, and they've been for so many years that it's hard to get a big institution like that down. So that's what we really want with this company, right? Let's go and look at our next company we want to go over is ZETA Global. We love this country. 18 straight beat and raised quarter end results. What in the world does that tell you about a company? What does that tell you about their management? Every day, 18 straight. So that means you can project this company out, go with their numbers and say, they're going to beat, and they beat 18 straight. And that's why the reason they're getting sold off is why? Because they're a SaaS company. They're the huge disruptor, right? They go in their basically thing is they have this proprietary first-party data they've been building for 15 years. Whenever they go in, help companies and market, the companies get actually a 6 or 7x on every dollar they spend with ZETA. And once they're in a company, it's like their sticky business model, because once you have them, they know all your data, have all your operations, and what they're going to do is they expand and spend more and more money on the companies each year because they see how much ZETA helps them. About 90% of their revenue comes from companies who've been with them for more than 1 year. So that's huge because you don't even have to track too many crazy companies. You can just keep building and expanding on these companies in this sticky business model where they're the disruptor if there is an AI disruptor in the SaaS space. So this is a great hedge if you're in a Salesforce, an Adobe, a ServiceNow, which we're going to move our Salesforce projections some other day. This is just a long video with all this stuff in it. But basically with our ZETA, right, we have them running at a base case. I'm just going to run through these a little bit faster, but base case, they just turned profitable, so we had to go change it on here and make sure the net income growth, we think they're going to do about a 1 EPS. And that puts them at with this P, that puts them at a 4 ratio of 1.05. But if they grow at 35%, the revenue grows a little bit, they're going to get up to a $91 share price for our base case here. And that's with them possibly trading at a PEG ratio of less than 1, right? You could have this coming right here. What if you put in a PEG ratio of 40 to 50, right? 105. And you put one here, right? Let's just make it like a 39 to 44, okay? It goes down. You're getting a $94 share price for a company in the SaaS that's so beat down that we have this year going to $44 share price. So you're getting almost a 3x this year on this company, which is crazy huge. So that's just your base case, and it's a company that is beat for the last freaking 3.5 years. That you know they're going to hit the numbers. If they hit these numbers, that's all they have to do. Their bull case, if they beat and they raise and keep going, they could very easily get to these numbers. They scale up more companies, and they're super, super sticky business model. We have them at $150 share price. So they go down a little bit. We have a little drawdown in the market. There's your 10x for the next years. There's your Palantir. There's your stock that you want to see. And their bear case, even though they're SaaS, we still have them outperforming the market. We still have them doing a 15%. If you can find a company that's outperforming the market by 5% with a bear case, that's a company you got to go love. I love this company. Be in with them. So that's just exactly what you want to see in companies. That's what we love. And they're just getting killed. They're growing. Their net income goes down to 30 to 20. Their revenue growth goes down to 15%, which right now, annually recurring revenue, based off these companies that they already have on them, is about 20 to 25% each year. So they're growing 25% a year just without even adding any new companies. So that's how troublesome. They would have to lose companies, become unsticky or something, which if you're so integrated in the space, how do you even switch off of a company like a ZETA? So our next company we want to go through is our Celsius right here. I think you guys know what happened. Costco came and say, hey, we have this energy drink. We're going to try to undercut Celsius prices, make some crappy drink that the girls who drink it every day aren't going to like, the gym guys aren't going to like, that people drink Celsius because it's taste. They have so many different flavors, not just 4 flavors that Costco's going to put up. Also, a lot of people shopping for Celsius at Costco are actually wholesalers who go buy it there, put it in vending machines. So that's another thing. So you're basically only losing 5% of your revenue a year if people actually like the Costco drink. And say only half of them like it, 2.5% of revenue a year just from this announcement that came in the stock actually. Celsius was trading at $57. Now look what it's trading at $34, $35 right now. So you're getting a stock at such a steal deal. And let's just show you what we have for this company, right? Our base case is just them growing revenue with what they say, this net income. They had some one-offs last year. Let's go and look at I think they're on their income statement here, right? Basically, they had one-offs in all these that made their margins and everything look super, super horrid on their income statement that completely destroyed them. But overall, you can see that they went up so much, and that's why their net income went so much down, just because of all these one-offs and extra expenses they had on the outside of it. But basically for Celsius, we have them at $163 share price. They're a company that people are going to go buy every day. So think about how many people at the gym, how many people at the library studying, all these girls, if you know young girls, young guys who go to the gym, they're going to buy them every single day, that energy drink, so they feel good. They only got to be growing their revenue at 25% and net income at 30%, expanding their margins, which Monster has 20-something plus margins. They're only getting up to 16%, and they're not even trading at a forward peg of over 1, which the industry trades at about a 1.4. So you're just giving them a very little slow multiple. Monster, for example, right? They trade at a forward P of like 40-ish trailing 12 month. They're only growing their revenue and their net income at less than like a 20% clip for that company, and they're trading that high. Imagine a company like Celsius that could do. And it's such a big industry. There's always going to be people coming against it, but you got to know, say, hey, this company's the best. Their drinks taste the best. They have so many different flavors. They're so hard for a Starbucks, a McDonald's, a Costco to come and copy them. Their bull case, we have them about a 60% CAGR. We have them getting up, just not even growing that crazy. They just got to grow revenue in the 30s for one extra year, basically, and they got to keep their net income growth up at about 35% for the next years, which is pretty doable with the Ilani in their corporation just growing like crazy. That is your company. If they get down a little more, that could be crazy 10x for you. 60% for a consumer defensive or consumer staples, a pretty great price to pay. And then even on your lowest bear case, you're still growing at 7.24% on the mid price. They're down to trading to around a 20p, even though they're growing net income at 15%. These are crazy low for everything that they're doing here. And basically, they have a buyback. They could be buying back shares. Their revenue growth would have to completely fall off a cliff, which, how likely is this? Maybe like a 5%, a possible like more likely. Just they go 20, 15, 15. I mean, they don't grow net income, and I mean, their margins still would be 11. Like, how low are those margins? Like, you're still probably growing at, say you still grow at like a 17% clip, right? You're still going to go and trade at almost, and say they go and they trade, hey, higher, like a 20 to 25, right? Just say like the industry almost average, right? With these margins and everything growing there, say they grow, this one grows at like a 16. Okay, here. So basically, that's all you kind of need for this company here to grow. And look at these numbers are horrible. They would have to completely fall off if they beat. You're still getting about a 10%. You're still doing around the market, even maybe a little bit better with a bear case for stock. A bear case for the market is 20% down in a year. A bear case for this stock over the next few years is 10%. And that's why you got to buy low and sell high. Our last stock I'm going to show you is HIMSS. What happened, right? They got killed, their stock tanked because of the GLP-1 pills and their problem with NVO. Now they re-signed with NVO, and people go and are buying them back up again. All that worries about their growth is going to go away with all those GLP-1 attracting people to the company. That's gone, right? They're back. People want to go, and that's why they're being invested. They're still trading at only $20. They're trading before that. They're trading about $40. Just look at our projections for how high this company's going to get and what you're going to be able to do with them. So their base case, we just got to go 23%, say it's a down year this year. Then their net income growth, their adjusted EBITDA margin is supposed to be like about a 20% by 29. That gives you roughly about a net income margin of 13% after the math. Trading at a P of 45 to 55 is even under. They're only trading at a PEG of 0.67 at this point, much less in the industry, so they could go higher. And you're getting a CAGR of about almost 60%. Your bull case growing at just what, 25% revenue, 60% net income growth, getting your margins up. Say they traded a little bit higher, get a little bit higher EBITDA, outperform what they think they're going to do. Right here, that's about a 10x with this stock right here from that 21, where you're getting about a $200 share price at the top. Just imagine how much these stocks, how much these prices could go up while you're buying them. And their bear case still what? You're still outperforming the market. 13.36% CAGR mid. The high of your bear case, 20%. You're outperforming the market by 2 times with the high of that. So just think about companies like this, and they only have to grow revenue at 10%, net income at 30%. Those margins, they miss that EBITDA margin, and they're trading at a forward peg of still 0.59. Maybe is it still a little bit low? We like to be conservative with our pricing? So just think about this. You could still bidding in a stock, the worst possible case that we have happening, 20% growth. It's just incredible. And then our other projections, which we didn't show you for here, we have our PEG ratio projections. Sorry, my Wi-Fi is very bad here right now. But basically, you're going to have these PEG ratio projections with the company. You could go put in here. And let's just show you OSCR. I think we have a price of sale because, right, OSCR, they are not profitable, so you can't do that. OSCR, just see what, like, you just put in your price of sales, get these ratio, get what they're going to be growing at, overall CAGR. And then, I mean, I guess just at the end of the video, let's give you an extra bonus stock out here just for being attentive and listening to the video that we weren't going to do. Let's go into our Salesforce stock. What in the world's happened in the IGV? Like we said, ZETA. They're getting killed because they think AI is going to come in. The problem is, though, imagine you have a lemonade stand, right? And you have something to track your expenses, all of your taxes, how much your costs, you're selling, your operating income, all of that, and to see like, hey, where are we buying this from? How much does it cost? And tracking all your employees at other places, and they can go on in a database and do stuff. That's what Salesforce basically does for these companies. They connect all parts of it, and it's so integrated at every part. Oh, maybe for lemonade stands, like a bleak example, you could switch easily. But imagine a huge billion-dollar revenue company that has Salesforce implemented. Imagine the cost, imagine the problems with having to switch, retrain employees. Why wouldn't you just stay with this company instead of going possibly with an AI model? Because it's already been in your company for 10 years, 20 years. Our base case is them only growing revenue at 11%, a huge buyback. Net income growth this year is going to be up because what we said, non-GAAP, GAAP. That's why that is. But basically, we have them growing about a 12% net income growth, barely getting any better margins, buying back a little bit of shares, which they're going to be buying back more and more because they have so much extra cash. Like, let's just go and look at their balance sheet, right? Salesforce here. Look at all this cash and cash equivalents they have. Cash, look at these ratios that they have. The best thing we even see, look at these ratios. Look how high these are and everything. Current ratio, quick ratio, cash ratio, right? They're going to be buying back because they already took cash out for this debt and buybacks, which in the long run, they're going to be okay. But like, yeah, they're going down, but just it's year-to-year change. This is the year 2026. This doesn't count here. This is what you're looking at these ratios right here because 2026 fully not. Look at what in the world they're doing with these ratios. Look, they have so much cash, it's going up. They have billions of dollars of cash to go and buy back for a market cap with this. So basically, that's what's going to be happening for them. And with what they're due, to even be trading at these, with these P's and everything, they're only growing P ratio of 20 to 25, which a forward peg 1.4 in the industry. So that's way lower than they've traded at their whole span. And with this, we have them growing about a 22% CAGR. So a nice thing if you want more of like a betting on that industry coming back. They're a company because look at their base case here. You're still performing right around the market with their bear case. If they're growing really low and they get such a compressed value trap P ratio, you're not even having to worry about that value trap because it's just ridiculous that they're getting made. And look at, you could even get this P ratio up here to 20. I mean, 15 to 20 wouldn't even be crazy if you could put in look what you're getting. If they just need to be trading at like a 17.5 P ratio for you to even like come and hit any of these marks, right? With their EPS growing. Oh my gosh, this is just that you can just have a company going just crazy, right? They don't even have to improve. They just have to not be a value trap where they're the one who's that sticky value so people can't just switch off. It's not like a PayPal where you could go have Apple Pay or these huge companies are competing against. And with this projection, you're outperforming the market still at your bear case. Your bull case, we have, hey, what if they actually get their revenue growth up, their net income growth up a little bit extra, and AI falls off at a little bit extra? Then you're getting a 33%. So Salesforce is one of those companies that, hey, AI is worried, but they're sold off so far that you can sleep safe at night and have that margin of safety in the company that you're going to be like, okay, this company can't go down too much. Thanks for watching. Getting to the end of the video. Make sure to like and subscribe and go check out the site and do your own projections. And there's help buttons, and let us know what you guys think if you find anything wrong or any additions to the features. We're going to be having so much new stuff coming up in the future.